Hello, mortgage fans. So this week is the first week all the kids are back at school. So for all the parents like myself, we're hoping to get back to some form of normality. Also normality around the school for the kids, which is great as well. And I remember in days gone by, this was also the week I would always get out of the country to somewhere nice and sunny and warm, where there weren't kids all around by the pool. So gotta miss those days, and if that's you, enjoy your time away. But even if you're in the UK, it seems to be nice and sunny this week for this non-event of a summer we've had. So hopefully you get to enjoy some sun before we kick into autumn. But things are certainly hotting up in the mortgage world. In fact, it's sort of getting back to those old days of rate wars and lenders are undercutting each other for both pricing and products and criteria. It's starting to get really quite competitive out there. I've talked quite a lot about just the rate side, so I'm going to focus on a couple of different aspects around that. So here are a couple of points that really caught my eye this week. Now the first one is always going to be the lead, is that mortgage rates continue to hit new lows. Last week, two of the largest mortgage lenders in the UK introduced sub 1% rates for the first time, which was Barclays and Nationwide, and there are now 8 major lenders offering best rates of sub 0.9%. So the best pricing out there, for 2-year deals or the 40% deposit in that sort of area, it starts at 0.8 something, which is absolutely mental. As I mentioned, it's really the preserve of those with larger deposits, but this is the cheapest time to ever borrow money on a mortgage officially. It's probably going to stay around this level for a while, but with the inflation outlook pretty flat, GDP pretty well, sort of not going nuts anyway, it's probable that we're going to have these low rates, maybe to the end of the year, but certainly through the summer. So we'll keep an eye on that one. What's of far more interest to me is that mortgages with smaller deposits are more accessible. So this is very closely linked to the above. I mean, what you've got is just on one level, lots of banks cutting their rates to be more competitive. So I think there's something like 6 lenders now, or about 4 or 5 lenders certainly, that are sub 3% if you've got just a 5% deposit. So again, it's never been so cheap to borrow with a 5% deposit. But the really, really important thing, this is sort of the key statistic for me, is there are 29 lenders now offering mortgages if you've got a 5% deposit. Now, if we roll back just a year ago, and certainly in the depths of the first lockdown, there were none lenders at this level, not a single one. So to go from not a single lender just over a year ago to 29 offering what's deemed often as the most risky types of loans, certainly to the bank anyway, not necessarily borrow sort of profile, but I'll come back to that another time. That's a huge, huge turnaround. Now that is very much largely down to the mortgage guarantee scheme that was offered in the budget last time out, but it's good to see government policy doing what it should do and getting banks lending back at this level, because if people can start to get into the housing market for the first time, then you get the first time buyers, that frees up the first time movers, and the whole thing starts working. The property market does not work if they're not first time buyers, so that's a huge improvement and something we're seeing gigantic changes in the last few weeks particularly. Last point then is really around lenders with an increased appetite for larger loans. So my inbox has been full of the last week of major high street banks who are upping their maximum loan sizes anywhere between 1.5 to 3 million depending on the bank, and there are some high street banks that will go north of 5 million. That's a slightly different thing. So pretty much as standard now, a bank will offer up to £3 million on the high street. So it's just the appetite on that is just again just massively swung in the last 12 months. So what banks I think are doing, or certainly the logic behind it, is that a lot of banks are going to struggle to hit their lending targets this year. So they could obviously do £10,000, £100,000 loans or £1 million loan. And I think that's sort of the logic, because where there's limited resource or it's harder to underwrite, it's easier for banks to get a lot of money on the balance sheet if they're doing larger loans. So I think that's the large driver of that. Now, also the added benefit of when high street banks come into this space is they pretty much offer their standard pricing. Again, it's up to that 1.5, £3 million mark in that bracket. You're pretty much going to get sort of the best buy rates. So that means you can lend potentially £3 million at sub 1%. Again, it's never been so cheap. And what we're starting to see is now a rise of that arbitrage sort of principle. And in this example, it's normally fairly simple, is that instead of a client putting down, say, a very, very large deposit, they'll really put down the minimum deposit they need to get the product that they want, and then any excess funds are then invested elsewhere. Because even in a fairly modest investment return, you can get maybe 5-6% return or more if you're willing to take more risk. So you can sort of see, again, just to for the sake of a simple example, if you can borrow at 1%, invest at 6%, then you're making a 5% gain. So that argument is starting to work again. So that's again specifically what we're seeing in the larger loan space. So how that translates into rates, so I've sort of mentioned what's really going on with some of the product pricing, but with the money market rates, pretty much all of them were down last week, but the outlook has pretty much been flat. Again, if you look at our website, you'll see the table that goes over the last 12 months, really back until about April or May. Money market pricing has been fairly sort of consistent, so no major changes there. Our default position stands if you've got a 25% deposit or more. Now is probably a great time to go for a longer term fixed product. But specifically in the money market rates, 3-month sterling last week was down by 0.005% to 0.063%. 2-year money was down by 0.019% to 0.47%. And 5-year money was down 0.13% to 0.704%, and the Bank of England held rates at 0.1% at their last meeting. And again, with the best mortgage rates out there, I've talked about this quite a lot at the top, but just to put some numbers to it, the best 2-year fixed rate is currently 0.83%, the best 5-year fixed rate is at 0.96%, and you get variable rates from 0.99%, and buy-to-let kicks in at 1.19%. So as ever, the actual rate you'll be offered will be dependent on your personal circumstances and deposit level, but please do speak to one of the guys who'll work out exactly what that means to you. Last point for me then is we've got a new video on our YouTube channel, which is around commission income. So if you do have commission as part of your remuneration package, please do have a look at that video, because that will talk you through some stuff as to how you can arrange a mortgage, which is actually probably much easier than you thought. So that's it for me this week. Hope to catch up with you next week. Enjoy the sun.